welcome back to part 2 of our Transactions in Securities podcast. We are finally talking about Osmond and Allen, which is the whole reason we actually first got together. So let's start off with just a brief summary of the facts, what actually happened. Pete, do you want to take it through it, or do you want me to
very briefly. So Mr. Osmond and Mr. Allen had shares in a company which were subject to EIS relief. In other words, if they sold them or disposed of them in a way that generated what might otherwise be a capital gain, that gain was exempt.
Yep.
In the end, they were concerned that the legislation might be repealed, so the relief would be lost. So they engineered a transaction where they effectively just cancelled the shares under the Companies Act rules in return for, I think, £11 million to Mr. Osmond and 9 to Mr. Allen, which was, I believe, the maximum extent of the capital gains relief they were entitled to. Oddly, they had done the same a couple of years earlier, which the Revenue didn't challenge, which has always been a strange feature of the case to me.
It's just luck, though, isn't it?
Well, the whether somebody notices it kind of thing. Yeah, I guess that might be true. Yeah. But either way, so this happened in relatively early in 2015-16. And to some extent, at least, I'm not sure how far we'll go down this road while we're talking about the case, but some of the decision or some of the arguments were about whether the Revenue had gone through the right administrative procedures in getting to the raising of the counteraction assessments. Yeah. But essentially, the Revenue counteracted what they saw as an income tax advantage because Mr. Osmond and Mr. Allen effectively still, I believe, controlled the company.
Yeah. Just to make the point, it looked a bit weird when you look at the Osmond and Allen structure. Why on earth they even got EIS exemption in the first place? Because, as you say, they controlled it. So they both failed that 30% connection test for EIS. But that's because it had gone through multiple reconstructions in the past.
Yes. Which led them they had a historical entitlement to the relief, which they'd maintained over the years.
Yeah, absolutely. So where were we? So the Revenue had counteracted. And in essence, then the whole thing came down to, well, as I say, there were lots of arguments, but the main piece of the argument I want to talk about today is that you effectively have a motive test. Now, at the time, excuse me, up until 5th April 2016, the test was one of the main purposes of the individual concerned in being party to that transaction in securities, the obtaining of an income tax advantage.
Yeah.
So for all the cases that are related to the 2015-16 year, and for various reasons, there are a number of them, large number of them, the question is, what was the motive, the purpose of each shareholder? Now, just to clarify why I make this distinction, because from 6 April 2016 up until the present day, and actually I think for pretty much the first 50 years that the legislation operated as well, the test was what was the purpose of the transaction in securities.
Yeah.
So then you'd be looking at the motive of the person who designed the transaction, not the motive of the person who entered into it. But for our purposes, it was...
in addition to the motive of the person who entered into it.
Well, maybe so, yeah. But really, it almost didn't matter. You know, if I designed the transaction in order to avoid income tax, but you entered into the transaction with no intention to avoid income tax whatsoever, then inevitably, technically you were safe. But anyway, so we're asking, or the courts were asking, court tribunal was asking, what were Mr. Osmond's and Mr. Allen's motives in entering into this transaction?
Yep.
And the traditional way of looking at this was to essentially ask them that question. Did you want to avoid income tax? And they said, in the traditional way, nah. We were just thinking, we got these shares, there's no capital gains tax on them if we get rid of them. We might as well get rid of them. Okay, there was a capital gains motive in that they were concerned that the relief might be taken away, And so that if they sold them after the end of the 2015-16 tax year or whenever the relevant budget was going to be, that they might pay capital gains tax. But if anything, that could only be called a capital gains tax play. And income tax had nothing to do with their thinking on the subject. I
suppose if you put it the other way around, we'll do this transaction, but you'll pay income tax on it. That transaction would never have happened.
I think that's probably true, or might not have happened at that time and in that way.
And then from extension, it's almost certain, I mean, I might be doing them an injustice, it's almost certain that they would have asked their advisors at the time, what are the tax implications of this? Will I pay income tax on it?
Yes.
And even if they didn't ask whether they'd pay income tax on it, they probably got assurance that there would be no income tax on it because of the structure of the transaction. And quite often, I think when you're looking at purpose, it's not so much, what's the purpose of this overall transaction? What's the purpose of this structure? And that gets us back to Marwood Homes again, because there was no good purpose to the little bit of the transaction that was gaining a tax advantage, even though the transaction as a whole was fine. And I think it's a difficult area.
It certainly is. And in a sense, this case was made even more difficult by the fact that on your standard argument, the tribunal actually found for Mr. Allen and Mr. Osmond in saying that on the sort of traditional argument, did they think about income tax at all? No. Did they know that under certain circumstances, this could be a transaction that carried income tax? Yes, they were probably aware of that. If they had chosen to pay the 20 million quid out as dividends, did they know they'd pay income tax? Yes. But since their intention was to crystallise the EIS relief, the background knowledge bit didn't matter. And there was some talk about the... God, I've forgotten the name of the case now. The lady with the clothing. Come on.
Pass. Oh, Mallow v. Drummond.
Yes, Mallow and Drummond.
Well, you see, it's interesting that because when I was running the clearance team, I was asked to go to give a talk at a partners conference. Can't remember the firm now, but anyway, fairly biggish firm. They asked me if I'd speak at the partners conference. And they accused me of all sorts of stuff. One of the partners stood up and pointed his finger at me and said, you just refuse clearances because you don't like them. To which I replied, well, if I refused every clearance I didn't like, I'd refuse most of them rather than 3% a year. But I brought up this point because there was a really well-known barrister in the audience. And I thought I would wind him up a little bit because I was working on what became Semigroup at the time.
Ah, right, yes.
And embedded in the Semigroup decision is this subconscious purpose. And the point I made was I thought it was only a matter of time before the special commissioners, as they were at the time, would accept that a subconscious purpose, in the same way it applied in Mallow v. Drummond, would also apply for transaction and securities, because it's too easy when you've got a transaction that just will give you a tax advantage or an income tax advantage. It's too easy to say, I never thought about the income tax at all. And this was what was happening in SEMA, that the fund manager knew that selling shares through a buyback in the way that was being proposed would give him a tax credit that he could then reclaim back on behalf of the pension fund, or could be claimed back on behalf of the pension fund. So even though he was saying, well, I never thought about the tax advantage at all, it was so obvious to someone conducting the transaction that tax advantage would be there. So I highlighted this possibility that Mallow v. Drummond would actually become good law in a TIS context. And when I finished my little slot, they wanted me to go away because they didn't want me to hear anything else that they were talking about. So I exited the room, and he came running out after me, and he's standing in the car park. He said to me, were you serious about that? Do you think that's really going to happen? And I'm saying, yes, of course. So, I mean, it is interesting, this, to what extent is subconscious purpose taken in? And you see the cases, they all say, you can't take it into account. And then they take it into account.
Yeah. And I think this is a very interesting area and in some ways quite a worrying one, because nowadays nobody does anything without at least speaking to their accountant, and any accountant worth their salt will say, well, let's make sure we've got decent tax advice on this. And there was actually a case where Judge Adrian Shipwright, as a judge of the First-tier Tribunal, was kind of compelled to say something roughly along the lines of, to counsel for HMRC to say, well, of course they consulted with their tax advisor about tax. I mean, they're hardly going to consult with their dentist about tax, or indeed with a tax advisor about their teeth. And, I'm hugely paraphrasing there, but, back in the old days, the 1960s, maybe even 70s, people didn't necessarily worry too much about the tax consequences of a transaction. I'm not saying didn't worry at all, but it wasn't, it's almost like tax advisors wasn't much of a thing. I joined KPMG in 1997, and one of the senior partners in the tax department had come to Birmingham at the time when KPMG in London had said, listen, Mike, we don't actually have a tax partner in Birmingham. Do you know anything about tax, or will you go off and learn it and then become the tax partner in Birmingham? I'm not saying tax wasn't important, but I think it has assumed a hugely greater importance over a 30, 40-year period. And essentially, that means all of these things like who you go and ask, Ray and I, we had a little break just between part 1 and part 2. Ray and I were reminiscing about a case that, again, it seemed to be relevant to Cambridge in the sense that the taxpayers were Cambridge-ish or Cambridgeshire based, and I had a meeting with them and with the HMRC, then Transactions in Securities team, here in Cambridge. And the interesting thing to my mind about the motive test argument in that case, although the revenue wasn't having any of it, was that the decision in this case to sell one company the guy owned to another company, or the guy and his wife owned to another company that they jointly owned, was actually made and then communicated to their accountant. And their accountant correctly spoke to the tax people within the accountancy firm, a Cambridge firm, and the answer from the tax department came back saying, oh, that's a pretty good result income tax-wise, essentially, which the revenue took as a smoking gun. And my client was saying, yeah, but if you look at the trail of correspondence, I'd made the decision before I told my accountant. So how can I be accused of wanting to avoid income tax?
Yeah.
But coming back to Osmond.
I think coming back to Osmond, I think we're kind of getting in here, what is their motives?
Yes.
Where they're going to struggle is convincing the upper tribunal that the first-tier tribunal judge got it so wrong that he couldn't have come to the decision that he did on the facts as he found them. Yeah. And I think that's just as, if not, well, in this context, it's more important now than the simple question in quotation marks. What were their motives?
Well, should we talk about though how the decision was arrived at? Because that, I think, to my mind, this is actually of vital importance. Even though you might be right about what might happen at the upper tribunal, but so. The traditional argument was, were you thinking about income tax when you made your decision? No, you weren't. We, the tribunal judges, find as a matter of fact that you were not. Therefore, you're fine. You win on the motive test. However, the revenue also put in an alternative argument, one which was sufficiently surprising that the tribunal judges admitted to having raised an eyebrow. We don't know which of the two judges raised an eyebrow or whether they raised one each. But essentially, the revenue's position was, since they were absolutely wanting to crystallize a capital gain, because it would be exempt from tax, they must perforce have been intending to obtain an income tax advantage, because if it's subject to capital gains tax, then it's clearly not subject to income tax. And on that point, the tribunal found in favour of HMRC, which, okay, let's ask a few questions here. This is where I find I am very, very uncomfortable with the potential ramifications of that decision. So,
which I think a lot of people are.
Yeah. But if you take it back, Pete, take it back to 1960 when the legislation first comes in. A transaction like this, there's no doubt whatsoever that the House of Lords in those days would have held that the TIS rules were properly applied to that transaction.
Do you think so?
Oh, yeah, absolutely. Absolutely.
Okay.
I mean, in what way is it? I mean, the difference here is that they're denying that they're giving thought to income tax. But, I mean, the reality is the transaction is structured in a way to ensure that there's no income tax payable on it. And I think the fault is, I might be doing the original advisors an injustice. The fault is at that time there was this widely held, albeit daft belief, that a reduction in share capital wasn't a transaction in securities.
Yes, I mean,
and I think there was probably some comfort taken from that. That, oh, well, we're going to do a reduction in share capital. It's not a transaction in securities, therefore the TIS rules can't apply to it. And they suddenly find that the revenue are up, snapping at their heels, arguing the exact opposite. So,
and indeed, nobody was arguing in Osmond that a transaction in securities had not occurred.
Yeah.
I mean, okay, if we go back to the 1960s, I think the difference is that the only tax was income tax. I mean, I don't mean the only tax there was income tax, but the only tax that could conceivably be relevant in that context was income tax. Whereas today, people think about a variety of taxes. And generally speaking, certainly when you are dealing with the shares of the company or the distributions of profits of a company and so on and so forth, you're talking about either capital gains or income. But let us imagine I've successfully run a trade for several years through a company. I have few material needs. Sorry, anyone who knows me, please stop laughing. Other people are trying to listen. And so I've taken a relatively small salary, occasional dividends, and the company, I've now decided to stop working. Perhaps I've sold the trade or just finished all my projects and not taken on any new work. So the company is now sitting there with, let's say, £500,000 worth of profits. And I'm thinking, what shall I do? Now, I could take a £500,000 dividend and pay basically about 200,000 of that, fractionally under, in income tax, and then wind up the company and get sort of £100 back share capital. Or I could put the company into liquidation and take out £500,000 as a capital gain and pay tax at 10% or whatever the rate happens to be at the time. Now, historically, well, okay, so let's start off with, okay, look at the motive test. Doing it the second way, winding it up and taking it out as capital, is generally seen as completely inoffensive. And I do not think HMRC, certainly before Osmond and Allen, would have given a moment's thought to raising a counteraction assessment under the transactions in securities rules. And I certainly wouldn't have given a moment's thought to it. Yeah. And it would have been the absolute standard thing to do. Now, as a result of the First-tier Tribunal in Osmond and Allen saying the very fact that you chose a capital gain or went for a capital gain means you were, perforce, one of your main purposes was the obtaining of an income tax advantage, means that you've basically lost, as it were, is that HMRC could go after absolutely everybody who decides to...
Yeah, well, see, that's where we differ, Pete.
Okay. That's
where we differ, because the bit that I'm not clear on, because it's not clear in the judgment, is where they're left after this transaction. Now, I think they still control the company.
Yeah.
And that's the key difference between the scenario you're painting there, Pete. Because the Revenue always had a fairly relaxed approach to the TIS rules in a situation where it was quite clear that the taxpayer was out and gone and the business wasn't continuing.
But my point to you is there's nothing in the legislation that talks about that. So I'm saying I've got a moribund company. There are two ways in which I can get rid of this company. One is I can take a dividend and pay income tax, and the other is...
But to repeat though, Pete, to compare the two and say that they're the same is to miss the point. So for example, if you and I are in business together and we equally reduce our share capital and we take out cash for that share capital repayment, we're caught by the TIS rules if there are distributable profits that could be got. If you and I are in business together and we decide that we're fed up looking at each other and we decide to close up the company and we liquidate it and we take the cash out that way, that's a capital gain. And it's probably, 99.99% certain that the revenue wouldn't even give TIS a moment's thought in that context, because the company's come to the end of its days, we've got rid of it, and that's the end of it. So I don't see the two scenarios.
Is it not? But I do, because there's nothing in either the judgment or the legislation about whether you continue to control the company afterwards and all of that sort of stuff. If I'm given, in effect, as everybody is when they reach this point, a choice as to how to get rid of my company, and I choose to go down the capital route, that wind it up and take all the proceeds, all my profits from years of trading out as a capital sum, then I must have chosen to do that over taking an income dividend and then winding up the company.
But that's always been the case, though. It's always been the case.
But we didn't have a judgment like Osmond and Allen.
But the judgment's not binding, though. And even if the upper tribunal decide that it's right, it's still not binding. Yeah, you're arguing your case on the basis of the facts as they are at the time. A relevant fact would be that the transaction that took place is actually the winding up of the company, because the business has come to an end. Each individual's going their own separate ways, and that's the end of it. I just don't see TIS applying in that situation, and I don't see HMRC trying to apply TIS in that type of scenario.
Well, I think the saving grace may well be the latter point, that HMRC probably, however desperate the government might be for money, HMRC probably has better things to do.
Well, of course, the next case you'll see will be exactly that point.
But and this of course is going to be the problem.
McCann's an idiot. He's got no idea what he's talking about.
But is that not a bit similar to, let's say you've got a sale on the table, a lot of people will, in their last 2 or 3 years, start building up cash instead of taking dividends, and then they'll take the free cash out as a capital gain. But when you said there's nothing in the legislation, most of the time that would be a fundamental change of ownership. So there is something in the TIS legislation that would mean TIS can't apply because there's less than...
I think that's probably fair. But the very interesting point is actually the stuff that was in the discussion paper in December 2015, which it was a discussion paper, not a consultation document, because the draft legislation for the 2016 changes, which, remember, also brought in the anti-Phoenix rules, had all already been published. And
you see, and that's the point, because when we were talking there, I was looking for a convenient moment to mention the TAR.
Yes.
Now, it doesn't make any sense. Well, actually, I'll take this back a little bit, because I made the point at the time that it didn't make any sense to bring in a TAR for a transaction which is largely still covered by the TIS rules, and to not extend the clearance arrangements to the TAR. But, the policy behind the TAR is to stop people getting rid of a company through the process that you're talking, but then continuing the business on in effectively the same form.
Yeah, absolutely.
Which the revenue used to always kind of, can we, will we, should we, would we? So, as I say, I think, I am pretty convinced that in the scenario that you're painting, the revenue won't look to apply the TIS rules.
Okay. But one of the things that discussion paper talked about was the fact that they referred to it as money boxing. So they decided to make up some new words for us. Everyone loves a neologism. But they would talk about people who, in the last few years of trading, and perhaps before they sold the trade and wound up the company or whatever, chose not to take dividends because they knew that on that winding up, or possibly sale, they would get a capital sum instead of income dividends. And then absolutely clearly, HMRC chose to do absolutely nothing about it. Indeed, I say HMRC, and theoretically we should say Parliament chose not to do anything about it. But since Parliament does what HMRC/Treasury tells it, as in ministers decide this is what we're going to do, or the revenue says you must do this to stop tax avoidance, minister, and they just pass it these days. And in a sense, the fundamental change of ownership test is just opening the gateway, because you just say, fine, I'll build up the profits in my company and then sell it to Ray, and I've got a whole capital sum. I mean,
and again, the fundamental change of ownership was always revenue practice.
Absolutely.
It wasn't quite as clear cut in the sense it was 25%, But I mean, the revenue used to always work on the basis that as long as they were satisfied that the taxpayer was exiting the business, then even though the TIS rules would, they ostensibly be satisfied, they wouldn't take the point.
But if I come back, I mean, I remember discussing at the time with a number of colleagues that if HMRC or Parliament was really keen on saying, look, you should pay income tax on your profits and capital gains tax on your capital gains. And I think this is where you do have a philosophical distinction. What is the value of the shares of a company? Then you could say, okay, suppose I sell my company. Let's not talk about winding up for a minute because that is a bit more complex. But supposing I sell my company and at the time, the value given is £5 million. And that includes the fact that there's £1.5 million of undistributed profits. Now, if we take a particular philosophical stance, you could argue that the right answer is I should pay income tax on £1.5 million as if I had received distributed profits. And £3.5 million is capital gains because although you'd argue that the increased value or the value of the shares is based on a measure of future profits to the buyer and this, that, and the other, at least those are not realised profits. They're still hypothetical, potentially not there at all, or could be bigger or could be smaller. But there's a sort of logic in there. Now, I am not suggesting this should be tax policy, though it could be a bit of a revenue raiser. So just a bit copyrighted Pete, just in case HM Treasury gets hold of this. But you can kind of see the logic there, and so if you're going to be a bit of a purist on this, you could say that's the way the system ought to be, and I would have had no problem with. Well, okay, lots of people would have had a problem with it from a tax perspective, but from a tax theory perspective, why should I be treated differently? Because I do things in this order rather than this order. Take the money out, then wind the company up. Oh, sorry, big tax bill.
Yep.
Wind the company up, then take the money out.
But you see, you'd be turning the tax code upside down, wouldn't you, if you try to eliminate every situation where a taxpayer can do transaction A or transaction B and have completely different tax consequences. So there's a limit to what you can do.
No, and I completely understand that. And this is only a hypothetical. Yeah. But and I guess in a sense it doesn't help particularly in our analysis of Osmond and Allen.
Indeed, and I think when you get back to that though, if I put my old HMRC hat on, if that transaction had come across my desk with that explanation, I would have thought, aye, right. It would have been as simple as that, and because that's what we pay tax inspectors. We pay tax inspectors to have that kind of slightly sceptical, very sceptical outlook, because it's too easy. It's too easy to somebody comes along and says, well, if you do a reduction in share capital, you can still own your company and you can take a pile of cash out of the revenue can't touch you. Because that's basically what the argument boils down to.
Yeah, because it comes. What was the case again? That the no commercial man in their right mind would structure a transaction to pay more tax, and that basically you're allowed to structure something how you in the most efficient
Duke of
way.
Westminster, or it's
It's Brebner. It's
Brebner.
Oh, sorry. It's always been very misunderstood.
Yeah.
That comment. It's always been very misunderstood.
It's quite different, isn't it? By our examples, Pete, when we're talking about basically stockpiling the cash and taking money, that's a way you might structure something, your affairs to be capital. Whereas in Osmond and Allen, and I don't know why I'm starting to side with Ray a little bit here. I know. Because I was on Pete's side originally.
Don't you worry. Don't worry.
Your appraisal's coming up.
You're in good company. You're in good company. But I mean, to get to the point with Brebner's misunderstood.
Yeah.
Everybody who quotes it, they just don't understand what the judge is getting at. And basically what the judge is getting at is that in very few cases will you have absolutely 100% clear evidence as to why anybody's doing anything.
No. Yeah.
Therefore, a lot of the time, and it's the same in Osmond and Allen and all these cases, you have to draw inferences at some point. And depending on how much evidence is there will determine how much inference you have to draw. Yeah. And all that Lord Upjohn's saying in Brebner is that the fact that you have to draw an inference from a set of circumstances on its own is not enough to decide that you've got a tax advantage. And if you take it into a different context, look at the loan relationship rules, the unallowable purpose. The mere fact that you borrow money and get interest relief on it or tax relief on the interest in itself is not something that you can draw an inference that you're doing it for tax reasons.
Yeah.
So it's the same here, and that's all.
Yeah.
They're
So
saying
I think the key difference with Osmond,
that, the mere fact that you get a tax advantage isn't in itself something that you can then simply say, well, I'll draw a negative inference from that fact, and that's enough.
So with Osmond, there wasn't a transaction that they were doing and they happened to structure it in the way they wanted. The transaction was for a tax purpose.
Yeah, the transaction's definitely
if there hadn't
for a
been a tax purpose, there would not have been a transaction.
Yeah.
And that is that is a fair distinction between all the other examples we've come up with, because when you look at some of the recent cases in this area, there has to be a could we have done it a different way? And there's no question that the thing that was being done for a largely commercial, or if not wholly commercial reason. Wilkinson and Delinian, the Euromoney decision, for example, are cases in point. It doesn't really matter what the basis of the decision was, but there were clearly commercial transactions. Both cases, a company was being sold, and they structured the consideration in part in order to obtain an income, or not income, a capital gains tax advantage in those cases.
And the danger for HMRC, if we bring it full circle back to the point we were making about when the commercial purpose was dropped, or bona fide commercial reasons was dropped, HMRC are now in a situation, and the tribunal judge does make the point that whether it's a commercial reason or a personal reason is irrelevant. Now, it never was irrelevant. And if you look at the stream of cases where, and it gets us back to Brebner again, they always drew a distinction between transactions carried out to achieve some commercial purpose and a transaction carried out just purely for personal gain. And Osmond is in the personal gain situation, albeit, both individuals said that they didn't need the money. That's fine. If I had 30 million sitting in the company,
so why are they appealing?
I wouldn't need the money either. It'd be nice to have, but I wouldn't need it either, because I've got it. So it's a bit of a kind of pointless argument. Oh, we didn't need the money, but we had the money. But the previous cases all distinguished between a commercial transaction and a personal transaction, and generally it was commercial transactions that the judges were more inclined to accept. It succeeded on the merits. And the golden rule with transaction securities is you must never lose on the merits at the tribunal, i.e. never lose on the purpose, because if you lose on the purpose, you've got the devil's own job of recovering it, which is why my point is the more interesting debate at the upper tribunal will be whether the judge considers that the first-tier tribunal judges misdirected themselves as regards what the test was and what the evidence showed.
And should we perhaps explain that a little bit? So there's a very famous case called Edwards and Bairstow and Harrison. And essentially, the decision that the courts came to was that if you're going from one level of tribunal or court to another, or certainly from the very first level. So the first level in those days, it was a thing called the General Commissioners, nowadays First-tier Tribunal. That is the fact-finding tribunal. Yep. So it's interesting to see nowadays how many decisions actually say, we, the judges, have found as facts the following. And they will be very often a complete restatement of what one side or the other has said, where there's no disagreement between the parties. So that way they are stating what are the facts that that tribunal have found. Yep. Now, supposing you then come to a decision based on those facts, the decision in Edwards and Bairstow and Harrison said, if that goes to a higher court, the higher court has to say, is this wrong? Is that decision wrong as a matter of law? Now, there are two reasons that can be wrong as a matter of law. One is you got the facts right, applied the law incorrectly. The other is, on the facts, you could not possibly have come to that decision sensibly, So, if you're all looking at me saying, or standing up in the witness box and saying, yes, he's definitely the one who killed that person, as it were, and you've got video, film and everything else. And then the judge says, well, I've listened to the evidence and watched the video and come to the conclusion that you're not guilty. Then that's clearly a perverse decision. And the judge could not, on the facts that have been found, come to that decision. So what Ray is saying is the question is not whether Nigel and Julian, as the judges in the first-tier tribunal, got their decision wrong, but whether a judge or panel of judges in the upper tribunal would be able to look at the facts that they found and the evidence they saw and say, on the basis of that evidence, on the basis of the facts that have been found and, again, largely agreed between the parties, that they could not reasonably have come to the decision that they made. And this is, I guess, where I do have some concerns because of the potential ramifications. And my concern here, quite frankly, is whether the transactions in securities bonds at the revenue will decide to start taking some of the sort of scenarios that we've been talking about and trying to apply the TIS rules to them. But just, I hope that was a decent explanation of why.
Okay, so to kind of bring this argument to an end, Pete, how is the upper tribunal going to overturn the first-tier tribunal's decision on the motive test, based on what we've just said?
I think they can essentially say that the evidence and facts that were found couldn't support a decision that on one level the obtaining of an income tax advantage was not a main purpose, because they made the decision purely on capital gains grounds, and then somehow impute. And I'm not quite sure how we got here, to be honest, because it wasn't really about subconscious motives and stuff like that. It was just, if you want a capital gain, you obviously don't want an income tax position, as it were. And I think they somehow got to find a way to say that that argument just doesn't hold, that the only way to knowingly, wittingly want to obtain an income tax advantage has to be by thinking about income tax.
Yeah. So you're basically saying the upper tribunal, the way that they would overturn this is by saying the first-tier tribunal took an extra step that they shouldn't have, that they kind of said that we have to assume something that wasn't there.
I think that's probably right. And before you turn to Ray, because I know you are going to turn to Ray and give him a chance to respond, which is most unkind of you. But it was interesting because we were talking earlier about whether there was something else in the evidence that didn't get reported in the case report and blah, 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 that might have kind of compelled the judges to find against Messrs. Osmond and Allen in that case, and that there's sort of, because there's always a hidden subtext, there's always something between the lines. Or by the same token, it is possible, I guess, that concerns about the future ramifications of that element of the decision at upper tribunal level could lead to the same result the other way round. You know, the judges looking for an out on this point. Now, obviously, the other concern is that if they win at upper tribunal, does the revenue take it to the Court of Appeal? And that will be quite an interesting question too. But sorry, please do turn to Ray.
So, Ray, from your perspective then, you're saying the upper tribunal won't overturn because effectively we do need to consider the subconscious element of this purpose.
No, I mean, I wouldn't put it that way. I mean, I think there's a possibility the upper tribunal might decide that the decision isn't right. I think it's a long shot for the reasons that we've explained with the Edwards v. Bairstow Harrison point. I think the decision that the two judges made at first tier level was open to them to make that on the facts as they found it, particularly since they accepted HMRC's argument that in designing the transaction, they must necessarily have intended to not pay income tax on what they were receiving. And as I say, I think it's just impossible to believe that the income tax status of the transaction wasn't discussed in fair depth. I mean, any advisor in this type of situation who didn't close off the possibility of an income tax charge wouldn't be doing his or her job properly. So it must be there. The area that I think is perhaps good ground for the defence, if I put it that way, to argue against it, is that there wasn't sufficient facts adduced to show that income tax was a main purpose, because it's not it's a main purpose. But the income tax was so significant I mean, we're looking at millions of pounds in income tax
We're
here.
talking about 6 million.
But it's just, as I say, it's just impossible to believe that it wasn't closed off and discussed in depth.
So,
and as I say, one slight concern I've got, or big concern I've got for them, is this idea that at that point in time, quite a few people were thinking that a reduction in share capital wasn't a transaction in securities, which may have lulled them into a little bit of a false sense of security.
is that because what we haven't really touched on is that they didn't apply for clearance?
And they didn't apply for clearance. And, you know, I mean, as far as I'm concerned, if you've got a high value transaction and it's within even, you know, hair's width of these rules, you should be applying for clearance because the clearance is there. There's nothing to be gained by not applying for clearance. Well, and it's never neutral. It's never neutral when it comes to the tribunal.
No. I agree with that. But you and I have had this argument quite a few times because at around that time, so the sort of latter part of the 2015-16 tax year, there were a lot of people doing Osmond and Allen type transactions for very different reasons. The very different reason was, oh, look, apparently, according to our advisors, we can whack a whole load of money out of our company in capital form and not pay any income tax. And I'm not sure if they were specifically being advised that it wasn't a transaction in securities because it was just a reduction of capital, because I certainly wasn't saying that. I mean, I've never had any doubt in my mind that reducing
you know what you're talking
capital. Oh, yeah. Okay. Yes.
Sometimes.
I knew there was a but in there somehow.
I didn't put but. I just said sometimes.
It's a but, in other words. But lots of people were effectively being advised they could do that. And so, you know, this was, I mean, that's why there is such a stack of cases built up in the background. And in a sense, Osmond and Allen is a case that essentially I almost feel that they're the ones who, well, obviously they were the lead case. It's almost a pity that the argument that several other people have got is going to have to be re-argued from First-tier Tribunal again.
Do you want to briefly mention that one? Because we've talked about the motive test, but actually there were 4 parts to Osmond and Allen. Do you want to just
very quickly run
literally about 2 minutes cover it?
Just before you do that, Peter, I'll just finish off on Osmond and Allen. One of the concerns I've got, looked at it from HMRC's perspective, is if you look at the policy behind EIS. Yeah. Now, the policy behind EIS is to give a certain amount of tax relief when you make the investment and to give you capital gains tax relief on the realisation of the investment.
For the purposes, the economic purpose of helping
if you hold it for the requisite time. Yeah. So you get 30% tax relief effectively up front and you get the capital gains tax relief. It's not to give you 100% tax relief on effectively your income return from the business in circumstances where you haven't actually disposed of it. Now, as I say, I may be doing them an injustice because it's not clear from my reading of the tribunal judgment precisely what they were left with. But if you're in a situation where you're reducing the share capital and you're still holding on, so the example I gave of Pete and I's business, if we reduce our share capital, we still own that business. We still own it. You know, the number of shares we hold are different. The value of those shares are different, which is why it gets into the transaction securities provisions. Yes. With or without a specific statutory inclusion. So when you look at it from a policy perspective, if everybody did this who was in that scenario, it wouldn't be too long before the government were thinking of scrapping EIS. So the revenue has to hold a line somewhere.
And I don't, it's been a while since I actually read the background of Osmond, but I don't think that the company itself was doing much in terms of activity to sort of be an EIS company, if that makes sense. So the policy of EIS is to help the economy grow, to help the startups. This company has now got to the point where it's no longer actually, I'm not sure whether it's even trading anymore. It's just got the £20 million worth of cash in it that they want to realise. So in a sense, you kind of think they're on the back foot with the tribunal because they're no longer just realising their investment and the company carries on, you know, doing what it's done. It's been successful under EIS and all those things. So I don't think that's necessary. But obviously the judge probably shouldn't be taking that into account, but it's certainly not helped them, has it? So, okay, that's the motive test, Pete. Your 2 minutes on the
okay, so there were 3 other points, all of which the taxpayers lost on. Number 1 was whether the transactions in securities rules could apply to a reduction of capital at all. Not because it wasn't a transaction in securities, but because there was what some people thought was a let-out for the repayment of share capital. And that was largely comprehensively dealt with in a case called Marcus Bamberg, again, about 15, 20 years ago even. It's quite a while, but I think it's about 17 years.
There's no new arguments.
No, exactly. The third argument was whether the preliminary notification had been correctly issued. So it was an administrative thing. And the tribunal basically said, yes, it had been, but even if it hadn't, there are sort of fixing provisions in the Taxes Management Act.
So that's the counteraction notice that HMRC issued?
Yes. No, it was the preliminary notification, not the counteraction notice. I think that's right. Yes, it was. I think it was the preliminary notification. It doesn't really matter. It was either of them.
Yeah.
And the last one, which is the one that Ray and I have talked about before, a long time ago. In fact, in the case that I mentioned that involved people from here in Cambridgeshire, is the timing, whether the revenue has 4 years or 6 years to raise that assessment. Now, post 6 April 2016, or post 5th April 2016, to be accurate, that time limit issue has gone away because all they have to do is open an inquiry within 6 years, and then there's no time limit for raising the assessment. But previously, the rules basically said for transactions in securities, all it said was you can raise an assessment, but you can't raise an assessment any more than 6 years after the end of the year of assessment or tax year in which the tax advantage arose, income tax advantage arose. And the question has been whether that overrides the general rule in Section 34 of the Taxes Management Act that says you have to raise an assessment within 4 years of the end of the year of assessment, unless you've got a carelessness. Is that right? Carelessness position. 6 years with carelessness, which isn't going to happen with the transactions in securities situation anyway. And the interesting thing was that it sort of didn't matter much before about 2008 or 9 when all the time limits changed, but they carefully didn't change the rule in
the revenue didn't. The revenue didn't. The one time I had to go at the revenue over the time limit, they didn't like my argument either, and I took it rather sort of gamefully back to 1952 and the Taxes Management Act 1952 and demonstrated that the same form of words was used from 1952 right up until the current time, and therefore the fact that Parliament didn't change that 6 year when the time limit was reduced to 4 was just because nobody thought about it.
Which is interesting because I did hear anecdotally years later that they'd actually deliberately left it at 6 years. But be that as it may, that was the argument that there are a number of people going to run because that's the only argument.
But I think ultimately you just have to accept that it's 6 years. Because the whole thing's such a mishmash. HMRC used the Taxes Management Act for large parts of the TIS rules, but on the other hand, they claim that important parts of it are separate from the Taxes Management Act and don't rely upon it.
And this was actually brought up in the judgment on that particular point and references it from previous cases to the Taxes Act being a patchwork of stuff. And I kind of see the point, but actually the tribunal found that in effect, that the transactions in securities rules contained an entire self-contained system for determining that tax was due, for assessing it, for all sorts of other things, including, to some extent, the appeals process. But then when you actually look at it logically, that's absolute drivel because there's whole loads of other stuff around the tax code that have to be brought in to allow the thing to happen. So you've got your internal reviews that you can require, which are in the Taxes Management Act, not in the Income Tax Act, which is where the TIS rules are, and things like the standing over of the unpaid tax until the assessment. And so actually it's not self-contained. And
it's a mess.
It's a mess, and I think there are still extremely valid arguments for the 4 year rule. And more to the point, there's a lot of people who are thinking, well, I do hope Pete's right, or other people who've said the same thing are right, because it's the only argument they've got. But I could equally see that a first-tier tribunal and potentially later an upper tribunal or beyond would take what I think in Ray's case would be reasonably stated to be a purposive approach. So we'll wait and see on that one.
Okay. We should probably call it a day because our hour on Osmond and Allen has become almost 2.
Excellent.
But it's been a fantastic and fascinating conversation. So thank you both for joining me. And I really enjoyed coming down to Cambridge to do this one as well. So that was makes a nice change. And hopefully everyone found that really interesting like I did. And hopefully we'll catch you on the next one. Thank you.
Thank you.
Thank you.